So we continue with double entry, chapter 2 for accounting AS. Source of transactions. When we talk about transactions, transactions are exchange of goods for money. That is what transaction is about. That means you and I have sat down and we've discussed about trading, we've discussed about business. Then we have exchanged a value or a product for money. That is what transaction is. Do you understand that?
Yes.
Then we have two sources of transaction. So if transaction is done, it could be between business to other businesses, or the business purchasing some items that will be recorded in the business itself.
So external, internal.
So we have external, which involves the business with other businesses.
Yes.
That is an individual or a contractor or other businesses. Then we have internal, which forms those documents that the business would use for its own financial statement.
Expenses.
Yeah, no, it might not be really expensive. It's a transaction.
Yes, transaction.
You could be getting revenue also. But whatever information you get that the business can put together to prepare its own financial statement are from internal.
Okay.
Do you understand the difference between internal and external? So I wrote external. This is from another person or another business. Then it is internal because the document is prepared from the business. Clear?
For transactions.
Is it clear?
Yes.
So we'll go down to accounting for inventory. When we talk about inventory, we're talking about stock. So there are two situations about inventory. Either we are buying inventory, which is purchases, or we are selling inventory, which is sales. Those are the two situations about inventory or stock. So here they said a business buys inventory to the value of £500, paying in cash. What will be the effect? Now, just forget about the book now, focus on me. The business buys, I use dollars here anyway. The business buys a product worth of $500. So what will be the effect of this thing? It paid in cash. The business paid in cash, right? So that means our asset of inventory has increased by 500. Our assets of inventory has increased because we purchased inventory for 500. So our asset of inventory has increased. You get the effect there. Then we paid cash, right? So for paying cash, it means our asset of cash has reduced because we paid through the cash account.
Oh yes.
So we are going to credit cash account and we debit inventory account. Those are the two situations. You know, double entry is for every debit entry there must be a corresponding credit entry. So as soon as for every debit entry there must be a corresponding credit entry.
Yes.
So if we have purchased inventory worth of £500 or $500, it means we have to pay $500 in cash.
Yes.
Because we said this inventory was bought in cash.
Yes.
So for us to have the inventory, we would have paid cash to the supplier.
So whatever we paid for, we still have the same price of it.
The same value of it. That is why it is a transaction.
Yes.
So the transaction goes this way. We have a debit because you debit the receiver, you credit the giver. So we have received inventory worth of 500. So we debit inventory 500. Our asset of inventory has increased.
Yes.
So we are going to give cash out to the supplier. Yes or no?
Yes.
We credit the giver, which is what? Cash.
And credit is assets, the capital.
Credit.
Okay.
A credit entry. Capital is a credit entry, but we're not going there. We are talking about a credit entry in double entry now.
Okay.
So we have inventory. Inventory has been transacted for cash. That is the transaction. Inventory for cash. Mm-hmm. So we receive the inventory. That means our inventory account will be debited. We paid cash. That means our cash account will be credited. Mm-hmm. Do you understand? So you debit inventory account, you credit cash account. That is the double entry. Do you get the point?
Yes.
Now, if we didn't pay cash, we paid through the check or bank. Maybe standing order. So if we pay through bank, we're going to still credit bank and debit inventory account.
We're going to credit bank and debit
inventory account because the bank paid. We paid through the bank.
Yes.
Do you understand that? And the last situation is if we buy the goods worth of 500 on credit. If we paid through cash, our asset of cash reduces. If we pay through bank, our asset of bank reduces. Now we are buying we bought on credit.
So our liabilities increase.
Thank you. Our liabilities will increase.
Yes.
because we start increasing we start adding liabilities.
Yes.
So we're going to credit the trade payables. We're going to credit the supplier's account and debit inventory account. That is a simple double entry.
Okay.
Do you understand the first point
Yes.
there? So that is for sales. So for purchases, sorry. So if you purchase, you can either purchase through cash, bank, or on credit.
Yes.
So whatever you purchase with will be credited. The inventory that you purchased will be debited. Clear? Then we go on to the sales of inventory. For sale of inventory, it means the business is selling now, right? The business can sell through bank or cash, or the business can sell on credit.
Credit.
Do you get the point here?
Yes.
Good. So if the business sell through cash, the asset of cash for the business would what?
If we what if again?
If we sell on credit, or if we sell through cash, we sell with cash. What happens to our assets of cash?
Increase.
It will increase. So we debit cash account, we credit sales account or inventory or whatever we sell. If we receive a check for the sales of the product, our asset of bank does what?
If we receive a check for our product.
For the sales of our product, our asset of bank does what?
Instead of
If you sold now,
yes.
but instead of receiving cash, you were issued a check. What happens to your asset of bank?
Increase.
It increases. Do you get that?
Yes.
That is the second situation for sales. And the last situation for sales is on credit. We sold on credit. Our assets of inventory would reduce. Our revenue would reduce, yeah? So we're going to have a credit entry for revenue.
Yes.
We're going to have a debit entry for cash or bank. Yes or no?
Yes.
Now, we sold on credit. What happens to our assets of... So, if we sell on credit, we're going to have what we call trade receivables. What do I call it?
Trade receivables.
Which is the same as credit customer.
Yes.
If we buy on credit, we have trade payables, which is the same as credit supplier. When we buy on credit, we have to pay back, right?
Yes.
It is trade payable.
Trade payable.
When you sell on credit, the customer has to pay back. You have to receive from your customer. We call it trade receivable.
Okay.
You get the point here? So now, you bought on credit, you sold on credit. What will happen?
We sold on credit, so our credit will increase.
Our assets of what? Not credit.
No.
You sold on credit. That means you're going to have a trade receivable.
We sold our credit.
We
which
sold
have to
our
pay.
product on credit.
Yes.
You're going to have what? A trade receivable.
Trade receivable. Okay.
So, does it increase or reduce?
Reduce. Increase because our assets will increase.
Our asset will increase.
Yes.
Trade receivable is an asset.
Yes.
A current asset. We have trade receivable as a current asset. We have inventory as a current asset. We have cash as a current asset. We have bank as a current asset. We have stock as a current asset.
Yes.
So, if we sell on credit to a credit customer, we're going to have a trade receivable.
Yes.
So, what happens to our trade receivable? What?
Increase.
Say it out, please.
Increase.
It will increase because we sold on credit. The trade receivable has received the goods from us. We say we credit the receiver, we debit the receiver, we credit the giver. So our asset of stock or revenue would reduce. Our asset of stock would reduce because we have sold on. We've sold on what?
Credit.
On credit. So the double entry system is that cash, trade receivable will be debited, inventory will be credited.
Okay.
Is it clear?
Yes.
Any question about that?
We just finished source of transactions and accounting for inventory.
Is it clear?
What's the tradables?
Hold on, please. You have a question?
No.
Okay.